Thank you for joining today's Technology Transactions webinar. Our program today will focus on contracting for digital platform relationships. My name is Brad Peterson, and I'm delighted to have the opportunity to introduce today's program. I'm a partner in Mayer Brown's Technology Transactions practice here in Chicago and lead our global technology transactions practice, which has 50 lawyers around the world specializing in data, digital, outsourcing, and software transactions. For us, the hottest growth areas are the digital transformation made possible by automation, AI, and robotics. And one key way to accelerate those digital transformations is by contracting for digital platform relationships. I'll cover first a few administrative matters, and then we'll get started. First, at the bottom of your screen, you will notice that there are multiple application widgets that you can use. All of the widgets are resizable and movable, so feel free to move them around to get the most out of your desktop space. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner. Today's program is being streamed through your computer, so there is no dial-in number. For best audio quality, please make sure that your computer speakers or your headset are turned up and the volume is up so that you can hear the presenters. For the best viewing experience, we recommend using a wired internet connection, preferably with Chrome or Firefox browsers, and closing any programs or browser sessions running in the background that could cause issues. Some networks cause slides to advance more slowly than others, so logging off your VPN is recommended. If your slides are behind, pushing F5 on your keyboard will refresh the page. You can find answers to some common technical issues using the Help widget at the bottom of your screen. For CLE purposes, during today's presentation, we will provide you with an alphanumeric code. If you are applying for CLE credit, you'll need to record that code on the virtual sign-in sheet that you received by email with the connection details. You can also find a copy of the virtual sign-in sheet in the resource list widget entitled CLE Affirmation Form. Directions for returning the CLE affirmation form are on that sheet. We will read the code in the middle of the presentation and then again at the end of the presentation. Please note, we also made the event evaluation form and presentation deck available on the resource list widget for your convenience. This webinar is being recorded, as we normally do with these programs, and in a day or so we will be sending you an email with a link which you can use to listen to the webinar again or to share it with your colleagues. The recording will also be posted on our website. We plan to allow time at the end of the program for questions. To submit a question electronically, please use the Q&A widget. If we don't get to your question during this webinar, we will make every effort to follow up with you afterwards with an answer. So with that, let me introduce our presenters. Here on slide 3. I'm pleased to announce my colleagues today speaking on today's webinar, Joe Pennell, Julian Dibbell, and Corina Cercelaru. Joe is a partner in the technology transactions practice. Joe is a frequent author and speaker on topics such as artificial intelligence, robotic process automation, fintech, data analytics, and outsourcing. He's also the co-chair of the ABA's Science and Technology Law's Cloud Computing Committee, was named a next-generation lawyer in outsourcing by Legal 500 in 2018. Prior to joining Mayer Brown, Joe received his JD from Harvard Law School, where he was the senior editor for the Journal of Law and Public Policy. Julian is a senior associate in our technology transactions practice, and before joining Mayer Brown in 2014, Julian worked as a journalist and an author covering the internet and other digital technologies. Julian received his JD in 2014 from the University of Chicago Law School, where he was a staff member of the University of Chicago Law Review and co-founder of the Law and Technology Society. Corina is an associate in our technology transactions practice, and before earning a JD from the University of Chicago, Corina worked as a software engineer and business analyst and consultant for American Family Insurance and Hewlett-Packard. So we've got a great group together with tremendous background on today's topic. And with those brief introductions, let's get started with today's program.
Thanks for that introduction, Brad. As Brad mentioned, I'm Joe Pennell, and I'm a partner in our technology transactions practice here in Chicago. Historically, a lot of our clients viewed technology as a way to generate cost savings on back office activities. Our clients are no longer looking at technology strictly as a back office function to enable their front-end customer-facing business. Technology is now key to generating new revenue, not just saving money. Increasingly, we see clients using digital platform technology to transform their front-end customer-facing business. This usually involves a more established company contracting with a smaller, more nimble tech company to speed their time to market. We're also seeing some non-tech companies build their own digital platforms in-house. In some cases, the technology is good enough for them to become platform technology providers to other companies within their own industry. The goal is to generate economies of scale and seize market share before fintechs and other tech companies can beat them to the punch. Big issues come up in these platform arrangements, and they aren't always the same issues you find in back office tech services deals. So with that background, here's a brief overview of our agenda. First, what are these digital platforms? Second, how are companies acquiring platform capabilities? Third, we'll run through some platform deal examples we're seeing in the market. And finally, what are the key issues when you're contracting for revenue-generating platform services instead of back-office technology? So first, what is a platform? There are many definitions, but for our purposes, we define it as an integrated framework of digital tools and services, which typically runs in a SaaS model, software as a service, and that facilitates companies' sales of products and services to their customers. Put more simply, platforms are the technology foundation for any digital business. There are many types of digital platforms across a variety of industries and use cases. They're everywhere. You have collaboration platforms like Slack, marketplace platforms like eBay and Etsy, and fintech platforms like SoFi and Robinhood. Platforms vary from being many-to-many systems like Uber or Venmo to more traditional exchanges, where a single company is trying to reach many consumers. Unsurprisingly, the platform economy is booming. 7 of the 10 most valuable companies today use platform strategies. KPMG estimates that the size of the global platform economy is $7.2 trillion, and it's growing rapidly. This multi-trillion-dollar economy is being driven by the benefits these platforms offer to companies and consumers. First, speed, convenience, and more efficient product delivery. Applying for a loan in a few minutes on your phone is a lot more attractive than an hour of driving and sitting in a bank branch. That may allow you to sell to mobile and other digital-only consumers you're not currently reaching, and it's probably rapidly scalable in a way that your bank branch footprint is not. Instead of your branch employees manually keying in loan application information, your customer does it for you and increases your productivity. Next, the opportunity to mine platform data for insights and efficiencies. And finally, depending on the platform structure, there may be valuable network effects generated by participation on the platform. So, faced with the risk of ceding all of these advantages to rival businesses, the question for most companies is not whether to get access to digital platforms, but how. Companies generally have 3 major paths to accessing digital platforms. First, they can buy all or part of a business that is already built or acquired a digital platform. We don't see a lot of companies pursuing this option, often because of high valuations in the marketplace today. Second, they can build their own platform using licensed or custom-developed software. This can be expensive. Most non-tech companies don't have the technology resources or the skill to effectively pull this off in a reasonable time frame, but there are prominent exceptions out there. The third option is to enter into a services agreement with a platform's owner. These platform collaboration agreements are increasingly common because they're usually a smaller investment in a working product, and it speeds the company's time to market. This approach definitely comes with some trade-offs, which we'll get into shortly. Note that there is a broader spectrum of other approaches, like minority investments and joint ventures for acquiring platform capabilities. companies often engage in combinations of the various approaches as part of their long-term digital strategies. So you might see, for example, a company enter into a services agreement with a platform provider and make a minority investment in a platform provider. That's a pretty common approach. So what are some examples of deals where we see companies acquiring platform capabilities? We're seeing multiple deals where a traditional bank white labels a fintech's lending platform or enters into some type of powered by arrangement. In many cases, this is an accelerated path for a bank to begin offering an entirely new loan product in a purely digital setting. In some cases, we've also seen banks rolling out multi-lender platforms that are developed in-house without a fintech. The recent Murphy versus NCAA Supreme Court decision paved the way for legalized online casino gaming and sports wagering in the United States. This has generated momentum for casinos to enter online gaming platform agreements with service providers to take advantage of this new market. Some of the earliest platform collaboration examples we saw were in-vehicle telematics contracts between automotive manufacturers and wireless carriers and service providers. And there have been an increasing number of fast food and fast casual restaurant chains partnering with food delivery platforms like Grubhub or Uber. A number of hotel chains have rolled out platforms that enable guests to unlock their hotel room doors using smartphone apps. And finally, we're starting to see investment funds issue equity to investors via blockchain platforms. This is just a snapshot of the platform trend we're seeing across many different industries. And just to give you a visual of how most of these platform collaboration agreements work, here's a diagram. The platform provider customizes its platform to look like the company's platform and sells the company's products and services to its customers. In some cases, the platform provider might also sell its own products to the customer. For example, a consumer turned down for a bank's loan on the white-labeled platform may have the opportunity to apply for a loan directly from the platform provider. On this slide, we've got a breakdown of the marketplace or many-to-many platform. You have multiple participating companies, all offering similar products or services, which customers can shop for and compare. The platform owner may be a pure technology provider or a participating company too. So just like that diagram, let's say you're a non-tech company that is rolling out your own platform for use by other companies in your industry. What are some considerations you'll need to take into account? If you're in a regulated industry like banking or insurance, you'll need to split your brain between contracting like a regulated entity and contracting like a platform provider. Your form agreements probably contain every belt and suspender imaginable to please your regulators. You may have to keep some of those provisions to address both your and your platform customers' compliance needs. But you'll also need to think like a platform company. How much risk are you willing to take on in your contracts with companies participating on the platform? How are you going to make the platform participation contracts easy to negotiate and manage? You don't want to manage a complex collection of bespoke contracts that overpromise on your capabilities. Switching gears to the example we're seeing more commonly right now of a company partnering with an existing platform provider. What's different about doing one of these platform deals instead of a traditional technology services deal? Some well-established platform providers have standardized platforms with standardized contracts. There may not be much room to negotiate with these providers. On the other hand, there are newer market entrants in the platform space in a variety of industries, like financial services, insurance, and healthcare. Contracting arrangements with these newer entrants tend to be more flexible than their more established competitors. Many of the issues from ERP, SaaS, and other IT deals are pretty similar, but there are a number of unique platform issues and risks too. These issues and risks arise primarily from a few key aspects of many platform providers. First, they are in direct contact with your customers, which is atypical in most technology deals. Second, they may enter into an independent relationship with your customers or prospective customers. Finally, Platform providers are often highly leveraged startups seeking rapid growth. There's a risk of jumping in too fast and losing money on an agreement with a new provider who overpromises and underdelivers. All of this means you're likely to have increased reputational, operational, security, and other risks to address in your contracts. It also means that you may need a different negotiating team for these contracts. Your traditional technology services deals may be led by your procurement team, and your traditional sales channels deals may be led by your line of business. These platform deals, however, are usually part of your overall digital strategy. They require strategic input and leadership from your digital strategy and corporate development teams who have an enterprise-wide view of how the platform will fit into larger goals that your company is pursuing. So, assuming you have the leverage to negotiate with a platform provider, what are some of the key risks and issues that you'll be facing? We'll run through this list on the screen. Julian, over to you.
Thank you, Joe. First key issue is control over the digital platform. One aspect of that issue is when can the platform provider change the platform without your approval? The platform provider is unlikely to agree that the company has approval rights over all changes to the digital platform. The platform provider may, however, be more willing to agree that any changes that are consumer-facing or that impact the cost of services under the agreement will be subject to the company's approval. On the other hand, the platform provider will want to have full flexibility to make changes to the platform that have a minor impact or that the platform provider implements for all of its customers. Now, when can the company demand changes from the platform provider? The company should build in provisions that allow it to require changes in order to comply with applicable laws. It should also have the right to make changes that are recommended by a regulator, even if not strictly required by the letter of the law. There should also be rights to make mandatory changes related to the products you are selling on the platform, like your underwriting standards and your credit policies. The next set of key issues is the core commercial issues, scope, pricing, and service levels, SLAs. As in any technology deal, you'll want to build a good service description, but you may want to get more prescriptive when it comes to the provider's interactions with your customers. You may want to develop detailed customer journey specifications for use of the website or the mobile app that your customers are interacting on. You may want to carefully script all messages sent to customers and provide and agree upon call center playbooks and scripts. These concepts are often detailed in business requirements documents that are used to customize the platform for the company after signing. Pricing is also quite a bit different from a back office services deal. In a back office deal, the usual goal is to keep the charges as low and fixed as possible. In a platform deal, however, you are probably paying the provider based on customer sales, and both parties have an incentive to drive sales as high as possible. So while you still want to minimize charges, your bigger concern may be ensuring that controls are in place to make sure the platform provider does not behave unethically to drive greater sales for both parties. Service levels. The kinds of service levels will be familiar to anyone familiar with technology service contracts, but with a heavier focus on customer experience, measuring things like speed of the platform, call center metrics, and speed to resolve customer inquiries and complaints. Generally, as well, the SLAs are going to be more straightforward than a back office services deal. In your outsourcing transactions with companies like IBM or Accenture, you probably have complex mechanisms for measuring and calculating service levels. There are probably complex weighting factors, percentage pools, expected and minimum SLA targets, earn-back concepts, and other sophisticated protections. The IBMs and Accentures of the world have the large delivery teams to manage all that, but your platform providers probably don't have the resources to manage a complex SLA methodology. So instead of 20 or 30 SLAs, you may have 3 to 5. And the credit mechanism, the service level credits mechanism, may be substantially simpler. Whether you are dealing with a startup platform provider or a bank offering a many-to-many technology platform to other financial institutions, they probably aren't going to have the resources to behave like a back-office outsourced service provider. Another observation on SLAs. If the platform provider is compensated based on revenue generated, and SLA credits are based on an at-risk amount equal to a percentage of charges paid to the provider per month, the at-risk amount for SLA credits may be artificially low as you ramp up platform revenues at the start of the deal. Consider, in that case, setting a minimum at-risk amount floor in the early months of the contract so that the platform provider has sufficient incentive to provide a high-functioning platform for your customers. Unsurprisingly, customer complaints are also an important issue in most platform deals. The platform's direct customer contact magnifies any platform performance issues, both to your customer base and your regulators. Platform is probably white labeled or co-labeled with your brand. So if there's a problem, your customers and regulators are going to blame you. That may require additional contract protections from both a reputational and a regulatory perspective. Think of the examples Joe mentioned before and what can go wrong. Lending platforms, for instance. Any issues in loan origination or servicing can easily result in angry customers and regulatory scrutiny. Online casino gaming. If the platform isn't paying out your customers' winnings, you're going to have business, reputational, and regulatory issues. With all of this as a backdrop, the provider may find itself receiving complaints directly from the company's customers or even from regulators. For operational simplicity, it may make sense to have the provider handle most of those complaints and route the most sensitive complaints back to the company. For those of you whose companies are subject to consumer protection regulations, you probably have far more robust processes than the platform provider. But you may end up using a simplified process that is consistent with their practices for their wider client base. In any event, you'll need to carefully document the platform provider's complaint handling obligations and make sure that they're at least consistent with your internal complaint handling policies and applicable laws. Moving on now to compliance with laws more broadly. You may be obligated to cause the services and the platform to comply with all of the laws that apply to your company when the provider is acting on your behalf. So your company is going to be liable for any non-compliance by the platform. Additionally, because the platform is going to be directly accessible to your customers, any failure to comply is likely to be more visible to your regulators and draw more scrutiny. This is a particularly thorny issue for companies in highly regulated industries like banking, healthcare, or transportation. The platform provider, on the other hand, will probably try to narrow its obligations to compliance with laws applicable to the provider in its provision of the services. That universe of laws is generally small because the platform provider probably isn't subject to the sector-specific laws that apply to your company. At the same time, they aren't versed in the laws and regulations that apply to you. You'll need to find a resolution that provides adequate protection for the company and that is still feasible for the platform provider. One typical compromise we see is to accept the platform provider's position, but also make them responsible for violation of other laws resulting from the platform provider's breach of the agreement or their failure to follow the company's instructions regarding other laws. A related topic is the decisioning process on the platform. This is particularly important for platforms that will be used to perform regulated functions like loan or insurance decisioning. Why is this important? Well, your company will want to make sure that these decisions meet your company's quality standards and regulatory compliance requirements. For example, in a banking or insurance platform context, you want to make sure that the platform does not make decisions in a discriminatory way. At the same time, you also want to make sure the platform is accurately applying your corporate policies. If the platform is incorrectly extending credit or coverage to individuals when it should not, it could cause financial harm. Because of the financial, regulatory, and reputational risks of bad decisions, you want to have visibility into how decisions are made on the platform. First step is to look at who or what makes the decisions. Are there people, machine learning algorithms, or robotic process automation software tools making the decisions? Is it all of the above? Second, how are these decisions made? Does the provider make decisions based on clear, static guidelines from your company? And does the agreement include comprehensive audit requirements for the provider so that there is a clear audit trail? If so, the risks flowing from the decisioning process are somewhat mitigated. However, if the decisioning process is AI-based, it gets more complicated. The provider is going to make a promise of machine learning. As the machine learns, it continually updates its algorithm based on new data. The decisioning process will improve constantly. But are these improvements in the algorithm in fact beneficial or detrimental for your company? Do they remain compliant with relevant regulations, such as Reg B in the financial space, and with your company's quality standards? You have to keep in mind that your company is just as responsible for decisions made by software as those made by people. With the algorithm changing constantly, you may be unable to know in advance how decisions are made, and it may be difficult to audit those decisions. One way to address this is to require the provider to update the decisioning model only on a set schedule, for example, annually. The downside of that approach is that you may be losing a lot of the benefits of machine learning by doing so. If the provider has an update to its algorithm to prevent more fraudulent transactions, you may not want to wait around a year to get that benefit. You may also want to consider incorporating in the agreement the right for your company to test that the algorithm or any proposed changes to the algorithm work correctly. If that is not possible, a compromise is to at least get access to reports and data from the provider demonstrating that the algorithm performs correctly and in a compliant and accurate manner. Another compliance area that may need special attention is antitrust. If you're an insurance company expanding your customer-facing sales platform to other insurance companies, you'll need to be careful. Will you be able to see underwriting or pricing criteria of other insurers as part of the onboarding process to get them onto the platform? If so, it might make it harder to defend against an allegation of collusion from a regulator. You may need to work with your technical team to see if there's an operational or technical workaround that allows you to onboard those insurers without seeing competitively sensitive information. Or let's say you're a bank that is white labeling a fintech's lending platform, and you want to prevent the fintech from cannibalizing your prospective customer base. You may want to build in protections preventing the fintech from soliciting your customers for other products and services. At the same time, from an antitrust perspective, you need to make sure that you don't draw those restrictions too tightly. If one of your platform customers were to independently contact the fintech about a different credit product, for example, you wouldn't want your contract to prevent the fintech from considering that customer's loan application for that unrelated product. In both of these examples, you want your platform agreement to prevent or prohibit any collusion around pricing, services, and other terms offered to potential customers. So it's a good idea to involve your antitrust counsel on these issues early in the process to avoid any landmines that might create the appearance of any collusive or anti-competitive activity. Finally, a note for those creating their own marketplace platform that other companies are going to participate on. If you're starting your own marketplace platform, you may also be subjecting yourself to greater regulatory scrutiny down the road. Politicians like Elizabeth Warren have proposed potentially prohibiting platform providers like Amazon from selling their own products on their platform. A very thorny issue in digital platform agreements is intellectual property. Branding and trademark rights are critical for front office, customer-facing platform deals. But there's a spectrum. In some cases, the platform may be completely white-labeled with your company's branding, with no branding from the provider whatsoever. More frequently, the company's brand is more prominent, but there is smaller branding on the platform indicating that the platform is powered by the provider, kind of like the Intel Inside stickers on your laptops. On a true many-to-many platform, a marketplace-type platform, the provider's branding will be more prominent than your own, since you're one of many participating companies. Depending on where you fall on this spectrum of branding options, you'll need to address the provider's rights to your trademarks and vice versa. If the provider has the opportunity to sell its products to your customers, you'll need to make it clear to your customers who is providing that product. For example, if your bank has turned down a consumer for a loan on a white-labeled lending platform, the fintech platform provider may want to make a loan offer to that consumer. In those circumstances, the website or the mobile app should be very clear about redirecting the customer from your website and your branding to the website of the platform provider. Preferably, that is accompanied by an unmistakable message that the consumer is no longer applying for a loan from your bank. If you're displaying the provider's trademark on your website to link to their platform, you'll need a license to use the provider's trademarks for that purpose. Any license of your trademarks to the provider must be limited to usage on the platform in specific and agreed ways that are identified in the agreement. Additionally, the provider must comply with your branding guidelines as they change from time to time. The agreement should clearly state that all use of your marks inures to your benefit, and you'll need to reserve quality control and approval rights over the provider's use of your trademarks and branding. That is critical in any trademark license to avoid undermining or destroying the value of your trademark. For many of our clients, their trademarks are worth billions of dollars, so it's important to pay attention to those issues. The next intellectual property issue is data rights. Why is data important? Data is the fuel for artificial intelligence, data analytics, and other data-driven systems. And the more data these systems have, the better predictions and estimates they will be able to make for you. Whoever has access to this data from the platform will have the ability to understand what your customers are interested in, what they're looking for, and what drives them to choose or reject products and services. At a minimum, you'll need to seek obligations for the platform provider to make this data available to you in real time, or at least on a regular basis. Beyond access to data, another key challenge is the general absence of intellectual property laws covering data. Data is not protected by copyright in the United States, which means you can't bring an infringement or misappropriation claim for a party's misuse of data. If your contract is silent with respect to data, the provider may use your data in any way that they please, subject to any data privacy laws that may apply. That may include selling your data, monetizing it for their own benefit, using it to improve their platform, or analyzing it to provide insights to your competitors. Absent intellectual property law protection, you'll need to protect data with strong contract rights. In the platform agreement, you'll need to clearly allocate data ownership rights to the customer and clearly define the platform provider's limited rights to use the data. That way, you can bring breach of contract actions against the platform provider if it uses the data for non-permitted uses. Right, what rights should the provider have to use your data? As a baseline, they should have the right to use it to perform the services. If they want to be able to use your data to improve the digital platform and its services, which you may want as well, at a minimum, you'll want an obligation to anonymize the data and use it on an aggregated basis with other platform clients' data. You may also want to narrow that further to specific use cases, like improving fraud detection models that benefit the entire platform provider client base. What about data that's owned by the provider? The provider may want to clarify that they retain ownership of data independently gathered by the provider from other sources, and they may want to own data about the technical performance of the platform. As a baseline, they should have the right to use it to perform the services.
Another big issue is developed IP ownership. In traditional back-office outsourcing or SaaS agreements, you're probably less concerned with developed IP ownership because you aren't outsourcing delivery of core functions and products to your customers. In a platform agreement, you're probably integrating the platform technology with your core product offerings and related IP. You'll need to consider who will own developed IP that incorporates both parties' sensitive IP and how to untangle that. What you'll want to propose as an opening position is to assign ownership rights to the company for all developed IP, except to the extent it is a derivative work of the provider's IP. Outside of that context, each party would own derivative works of its IP. Depending on the nature of the platform, that rule can be difficult to apply in practice. In the white-labeled fintech lending platform example, the developed IP may be a combination of the fintech's fraud model and the bank's underwriting criteria or credit policies. If there are practical challenges in separating that combined developed IP upon termination of the contract, the parties may consider requirements to simply delete or destroy that IP upon termination, or as long as it's no longer needed for ongoing audit purposes. Depending on the circumstances, the parties may decide that both parties have ongoing rights to use that combined IP. There's no single right answer. It may just depend on the circumstances of the deal. Finally, keep in mind that, as with data, material developed by the platform's artificial intelligence components may not be fully protected by IP laws, so you need to really be reliant on contract requirements to protect that IP. Corina will take it from here.
Thank you, Julian. Next issue, agency. Platform providers may have marketing, promotion, and reselling responsibilities that go beyond the operation of the platform. There need to be clear rules on how the platform provider can market on behalf of the company. The company should also establish clear limits on what the platform provider is not allowed to do. For example, the platform provider should not have the authority to bind the company to any contract except as expressly permitted in the agreement. You may also want to address additional topics like pre-approved operating territories, marketing channels, and publicity statements in operational documents attached to the platform agreement. A similar issue is subcontractors. Platform providers should be fully liable for the acts and omissions of their subcontractors. However, as a practical matter, providers may not have the leverage to ensure their subcontracts line up with the company's requirements on a term-for-term basis. This is often the case when a platform provider relies on a third party, such as Amazon Web Services, for the cloud infrastructure that the platform is built on. For financial institutions, there are particularly sensitive issues that can arise when data aggregation services are subcontracted for by the platform provider. Data aggregators typically interact directly with customers. Customers may authorize them to access their accounts with other institutions in ways that don't necessarily align with the privacy or other data handling terms that the platform provider has agreed to. Companies should also work to understand which agreement provisions the platform provider can realistically flow down to those subcontracted providers, and, if necessary, contract around any gaps. In some cases, though, companies should even consider whether to contract directly with third parties that provide key components of the platform. And that is because the transaction costs of dealing with multiple providers may be outweighed by the benefits of direct control and privity. You may also have increased negotiating leverage to get better terms with third parties in comparison to a smaller platform provider. Next issue is data security and privacy. Data security and privacy specialists are vital to any platform deal because of the platform's access to particularly sensitive customer data. Take the hotel platform example. Your platform app allows guests to unlock their hotel doors and may even track their location too. Think about the implications of that platform having weak security. You may be enabling a hacker to stalk your guests and unlock their door in the middle of the night. That would not be a customer relations or PR win for your hotel chain. Beyond the risk of personal data on your platform, there is also the risk of being on the same platform with your industry competitors. Logical security controls are always important in a multi-tenant environment, but when you are on an industry-specific platform with your largest competitors, these logical security controls may be just as important as external firewalls. Next topic, liability. As a general principle, there are no clear market standards for platform deals yet. The logic behind market standard liability terms and conventional back-office service agreements may no longer apply here. For example, back-office service providers often argue that they shouldn't be liable for indirect damages, like lost profits, that result from their breach of contract. That is logical when the services are delivered to your company, not your customers. The downstream effect on your company's profits is indirect. But what if your platform is delivering services directly to your customer? If the provider breaches the contract and fails to deliver services to your customers, the resulting lost profits may be considered direct damages under certain state laws, like New York. In some deals, the liability structures are very similar to what you would see in a conventional back-office service agreement. In other deals, though, we've seen clients take very different approaches to liability. For example, we've seen well-negotiated deals with no cap on direct damages at all. And moving on to indemnities, if you are allowing the platform provider to sell any of their own products to your customer, consider getting an uncapped indemnity from the provider for any resulting claims. And you may also want to control the defense of any claims from your customers and regulators. Provider's financial condition. As we mentioned earlier, many platform providers may be highly leveraged startups with financial challenges. That means that rigorous diligence before you even get to the contract is essential to make sure that the platform provider is stable enough to be a long-term partner. You may also want to build in obligations for the platform provider to deliver regular financial reporting that cover key metrics like current ratio. And the next topic, termination and disengagement. Diligence and reporting provides visibility into the provider's financial condition before and during the contract. That has to be coupled with termination rights for the company. You may want a termination right if the platform provider's credit rating or other reported metrics drops below certain thresholds defined in the contract. You may also want source code escrow protections for the software used to run the platform. We see this less frequently nowadays, given the technical complexity of SaaS platforms that run on Amazon or other cloud providers. That said, some clients still like to pursue it, and the escrow companies have new solutions that allow you to stand up SaaS applications that are cloud hosted. You will also want standard protections if the provider goes into bankruptcy, such as rights to retain and take possession for safekeeping all of your data and software and source code that you are entitled to under the agreement. And as an option of last resort, the company may also want to include a right to terminate the agreement if the platform provider behaves in a manner that is likely to adversely affect the company's reputation or that may otherwise result in violations of laws. And as we've mentioned before, a lot of these platform providers are startups. So if there is a reputational issue, their founders can probably just start a new company or change their name, but you probably don't have that luxury. You will need to be on the guard for trouble and be prepared to cut bait quickly if there is a problem. For any termination or expiration event, you need the right to retrieve your data in a usable format upon request and to get disengagement assistance so there can be a smooth transition to a replacement provider. To protect yourself further, as mentioned previously, you may consider negotiating rights for real-time access to your data during the term. And finally, here are a few other sticky issues in the platform context. First, you probably need robust audit rights for operational, reputational, and regulatory reasons. Those rights can be tricky to negotiate with a startup company because they may not have a deep bench of resources to be answering your audit inquiries. Next issue, employee background checks. Some industry regulations require background checks on personnel performing sensitive functions. Your background check policy is probably more stringent than the platform providers. You might send in fingerprints to the FBI, etc. The platform software developers will probably view your background checks as a fascist assault on their dignity. So, this kind of policies can be even trickier to impose when personnel and services are being provided by a subcontractor. So you will need to work closely with your compliance team to figure out what is truly necessary. And finally, the issue of agile software development for platform customizations. Platform providers are likely to customize their platform for you using agile software techniques. Agile is great, and it may really help you get to market faster and start realizing revenue. That being said, though, you may need to build in time and mechanisms to perform detailed code reviews, third-party security assessments, and penetration testing as the project progresses. You really don't want to compromise security in the rush to market. So, in conclusion, companies can reap tremendous rewards from commercial agreements with digital platform providers, but these agreements require careful planning to mitigate associated risks. Understanding the reputational, regulatory, IP, and other risks of these transactions will help companies successfully contract for platform services and digitally transform the customer experience they can offer. And I will now turn it to Brad.
Thank you, Joe and Julian and Corina. This has been a very informative presentation. It looks like we have a few minutes for the Q&A portion of the presentation. And for those of you with questions, please feel free to submit those electronically through the Q&A widget. We've gotten some already. As a reminder, if we don't get to your question during the program, we will make every effort to follow up with you after the program. And with that, first we can move to some of the questions that we've gotten in. One of them is, what trends are you seeing for supercaps related to data breaches? And if a service provider won't agree to uncapped liability, where do you see customers going?
That's a good question, and obviously one that's top of mind for all of our clients. This is Joe again. You know, the typical position, the company or the customer or the seller, depending on how you want to characterize yourself, would like uncapped liability for data breaches, but frankly, that's extremely difficult to obtain nowadays. And you know, typically where we see things going is some type of multiple of the base cap. So if your base cap is 12 months of trailing charges under the agreement is your liability cap, maybe you're looking at somewhere between 2 to 5 times that 12 months cap. And it's really a product of leverage. And another thing that we notice is that a lot of times with these platform providers who are frankly much smaller, you can negotiate potentially a really large cap, but sometimes the value of the cap may not be worth the paper it's written on, depending on the valuation of the company and the assets they realistically have. Also taking into account that they may have liability to their other customers if they do suffer a data breach. But typically we're seeing super caps in the 2x to 5x multiplier of the original base cap.
The second question that came in is, if IP rights don't apply to data, what ownership rights could be involved with data? And it's an interesting question because we were thinking about this just from the perspective of a platform services relationship, where it's not so much what rights might there be in the data, it's a question of what rights might you, if you are a seller, have in the data, a little bit distinct from the rights that the platform provider might be able to establish in the data. And Julian, would you like to talk a little bit about rights in data generally?
Sure, yeah. I mean, as we said, if IP rights don't apply as established by law, you're left with contractual rights. So you just have to be very careful and very clear about spelling out what rights you have, what rights really more it's what rights the provider has to use the data, and you're going to want to let them use the data for certain purposes, for the purposes of improving the services, certainly for the purposes of performing the services, but otherwise you're going to be very careful about restricting their use rights. I mean, that's really what it comes down to, use rights built into the contract.
And it is possible that the provider will have rights in data. For example, under copyright, you need to have an adequate level of human creativity, and you might have that in what you've written for what the chatbot says to the potential customers. Or you might have a level of creativity in the structure, sequence, and organization of the data. A thin copyright perhaps doesn't cover the underlying data of what would be helpful. Certainly, whoever has those contract rights, if they use reasonable efforts to preserve the secret of the the secrecy of the data, they would have trade secret rights. So that's all helpful. And you actually might want your provider to have trade secret rights that they would then be able to license to you, and you might be able to protect against misappropriation from third parties. But the difficult part is that as a seller, you don't have any of those rights unless you specifically contract for them. Another one we got was, you've talked a lot today about the key issues for a platform deal versus a back office services deal. What issues that are important in back office services deals are actually less important to fight about in a platform deal?
So in a lot of fixed price outsourced service deals, there is a materiality standard that governs when changes to the services are subject to mutual agreement and additional charges. Usually we call that a new services standard. and it's an important protection against the provider using immaterial changes to the services as an excuse to reopen the fixed price. So the new service standard says that the provider cannot demand additional charges unless the change requires performance of materially different services, the change requires materially different levels of effort or expense, and there is no current way to charge for that change under the agreement. In a platform deal, you are likely paying the provider based on revenue that the platform is generating rather than a fixed price that the provider wants to find ways to increase. So both parties are incentivized to maximize platform revenue. Given those incentives, the new services standards is probably less important to fight for in a platform deal.
Next one we've got, you've used many examples from the banking industry. What kind of banking regulation should we watch out for if we're in the banking industry? Joe?
Yeah, so just as a disclaimer, we're all technology lawyers, and we rely very heavily on our financial services regulatory and enforcement group to handle consumer financial regulatory questions. But the laws that we see continually come up in compliance with laws discussions are things like GLIBA, Equal Credit Opportunity Act, FCRA, FCRA, Dodd-Frank, the OCC third-party relationship guidance, FFIEC guidance. A lot of times the platform provider is running some type of call center or contact center for you, in which case laws like consent to record conversations or laws that cover do not email and do not call lists. All of those things are typically very front and center for the client in evaluating compliance with laws.
Here's another one. If my company has a partnership with a platform provider, is it reasonable to restrict how they can use my company's feedback about their software? And if so, what kind of restrictions would be reasonable?
So I think this comes up in a lot of transactions with platform providers and often with cloud providers and other SaaS providers too, about what the license rights are in suggestions or feedback or recommendations that the customer makes. And I think that there probably do need to be some type of restrictions on that in terms of if it's a suggestion that specifically includes your IP, that they can't use that for other customers. I know different clients that restrict this in different ways. How have you seen it in recent deals you've done, Brad?
It seems to be all over the map. Some customers are some sellers or some of our platform user customers are perfectly happy having their feedback used, and others find it difficult and see a risk that their proprietary marketing ideas might be taken. The biggest differentiator I see is whether the company has a good process for limiting whether they will provide those suggestions, and then whether the platform provider has a clear process for having things going to a specific suggestion box and the provision applying only to things applying in the specific suggestion box. I've got a last one, which I think is a really good point. On pricing compensation, if the compensation is tied to customer sales, isn't this a prohibited commission structure in the insurance industry? And yes, that is a significant problem in the insurance industry. And as a general comment, regardless of what platform provider you're working with, you need to think about the platform provider as another sales channel regulated in the same way as your other sales channel, as any other offline sales channel would be. And thus, if compensation mechanisms are prohibited within the industry, for example, there are prohibitions on commission structures within the insurance industry, and the 50 states are very concerned about that, those need to be abided by in a platform environment also. A platform is not something special that takes you out of those regulations. And I think with that, and I fear that we are slightly over time, that wraps up today's program. And on behalf of Mayor Brown and my colleagues, thank you for your time today. We do hope you found this program useful. So some final housekeeping items for today's participants. First, a recording and link to the materials in this program will be distributed by email to you in the next day or two. Please feel free to re-listen to it or forward it to anyone who might be interested. Second, for those applying for CLA credit, note that the certificates of attendance will be distributed within 30 days of the program date. If you don't see that bounce back right away, don't worry, it is coming. And third, to submit topic ideas or receive invitations to future programs, please do email us at techtransactions@mayorbrown.com. Thank you for participating, and this concludes our webinar.